It looks like the new listing market is back in business again because there has been a ton of new companies that have started trading recently on the public markets. So much so that it really seems like it's been a little hard to keep track of all of them. But the one I wanted to focus on today is Palantir. Hey everyone, thanks for joining me today. My name is Matt, and as I mentioned in the intro, today we're just going to review the new listing for Palantir. Now, if you're not familiar with Palantir, they are a software company that specializes in big data analytics. Palantir was started in 2004 with their 5 co-founders who are all still with the company today. Most notably though, they have their current CEO, Alex Karp, as well as one of their investors was Peter Thiel, who might sound familiar to you because he was also a co-founder for that little company with that other little guy called PayPal, started with Elon Musk, and he was also the first investor for Facebook. When it comes to the user base for Palantir, they have some very recognizable customers that use their software. To name a few, we have Merck, BP, Airbus, as well as a few government agencies, US government agencies, including the FBI and CIA. Now, when it comes to their involvement with U.S. government agencies, that is very controversial, and we're not here for the drama, we're here for the stonks, so we'll just keep moving on. As always, we're going to talk about the good, bad, and ugly about this new listing, but I want to start off on a more positive note. One thing I always like to see is that the software they have is a subscription base. Now, if you've been seeing my channel for the past few videos, you know I love subscriptions, so I'm not going to dive into that too much. Now, what I will say though is I could not find how much their subscription costs to use their softwares. Even on their website, I didn't really see any information about that, and I'm assuming that's because it's for more big companies. But I was able to see that they have currently around 125 customers that brought them around $700 million in revenue. So it works out to be about $5.6 million annually per customer. Obviously, give or take, there's going to be more that, or some that spend more than others, but around $5.6 million per customer in revenue, which is a large sum of money. And with that, 125 customers does not seem to be that many, but the CEO, Alex Karp, says that he believes their addressable market is around 6,000 customers, so that does give this company a lot of room to run. While they have been able to increase the revenues from the 2 years and the 12 trailing months that we could see, they are still not profitable. And I made a slideshow here, so we'll run through this so you can have kind of a visual representation for how they're doing with their revenues versus how much they actually make. So as you can see here, in 2018, I'm just going to read, it's in thousands, so this is all really in millions, but just bear with me here. I'm just going to read the numbers on the screen. You can do the conversions. So revenue in 2018, 595, 409, and in 2019, that was up to 742, 555. So a good increase to see over that year's time frame. I think that's around $150,000 increase in revenue for those years. I'm sorry, $150 million increase in revenue for those 2 years. And in the past 12 trailing months, they had around 901,115 or $900,115,000 in revenue, again, in the past 12 months. So that is definitely looking like it's on the right path. But as we could see here, and I don't mean to say that negatively, because as we could see here, so the income that they had was negative 580 million, 27,000 for 2018, and in 2019 that was 579,646. So we could see that it's slowly but surely starting to get more and more profitable. But for a $150 million increase between 2018 and 2019 to then just having basically $1 million difference in revenue does raise some questions for me. Now, what I was able to see though is around the end of 2018 or 2019, I apologize if I forget which one, they did finally start to hire a sales team and a new marketing team. So that is obviously going to be a very costly and expensive process for them. So that could maybe be why they were able to increase their revenues by such a large margin. However, the total profit that they made or lost wasn't as significant as the growth in revenue, if that makes sense. And as we could see for the 12 trailing months, we have 463,916. So again, it's headed in the right direction here, but they're still not profitable. And we cannot overlook that fact, even if it is headed in the right direction. as somebody who likes to see a strong and healthy balance sheet, this is something that's a little bit of a red flag for me. And also, just from doing my research, I've heard a lot of people, especially on YouTube, say that data is the next oil. So if that is the case, then this could become a very lucrative industry, and you could make the argument that maybe Palantir will have a little bit of a head start, given that they've been around now for 17 years and just are a little bit more established than somebody who started in 2015, 2018, or even sooner. Now, that being said, I feel like I've been a little bit too nice about this company, so let me talk about what I don't like about this new listing. And the first one is really the biggest one here, is that this is not actually or technically an IPO. This is a direct listing, and there is a huge difference between them. There's actually really kind of two differences between them. One obviously is going to carry more weight than the other. So the first one, less significant difference between an IPO and a direct listing, is a direct listing is going to be cheaper than an IPO. You're still going to have to work with an investment bank, but usually with an IPO, you work with an investment bank. They spend a lot of time figuring out your valuation. They find buyers for the shares. They connect you with the buyers for the shares so they can hit the public markets, and it's a very long process. A direct listing, you really use the investment bank for coming up with your valuation or assisting with the valuation, and then they're done. So it is more cost effective to go through the direct listing process than it is for the IPO process. That said, what would be most cost effective is just not listing at all. So if that was just the concern, was they wanted to go public but not pay as much, I mean, I guess. But the other big reason or big difference between the two is an IPO is commonly used as a way for businesses to raise money. So it's a way for them to issue new shares out to the public, and they receive money from that first listing. I've said before, but just in case you're new here or not aware of this, when a stock is trading on the markets, it actually has no impact on how much money the company receives. Yeah, people are compensated based on stock. You can make that argument. But just because the stock goes from $20 to $30 does not mean that, the company's stock that just went up $10 is receiving more in revenue. Once the shares have been sold to the public markets and they're traded on the exchanges, that's all that they're going to receive. So with a direct listing, though, there is no new money raised from going right to the public markets itself. So they're not going to receive anything because they're not creating new shares of ownership in this company. Which always raises the question, why would you do a direct listing then? Well, the big reason is because stocks are a very liquid investment. And basically, it's a very easy way for people to get in and out of ownerships within a company. So going through a direct listing gives some of those private investors an easy way out of the company to sell their portion of ownership within that company. And unfortunately, again, it creates a lot of liquidity within the company. And I typically do take that as a red flag because I don't necessarily want to be getting into a company where the people that have been there from day one or the private investors that know everything about this company are trying to get out. So usually a direct listing to me is a little bit scary of a situation to come across, but it's not totally uncommon. Spotify most notably did it, as well as a few other companies like Slack, and it doesn't always carry that negative connotation, but again, I just can't really immediately want to jump into a company where I know that there's insiders trying to get out. Now, I'm sure somebody out there would want to make the argument saying that even for this direct listing, they're going to have a lockout period where basically the insiders just can't sell everything they have all at once and causing the stock to crash. And that is, I guess you could say, true, but lockup periods are not common for direct listings. Very common for an initial public offering, but with direct listings, it's fairly unheard of. So again, it sounds to me that they're going to use this lockout period as a way to prevent all the insiders from being like, yes, here's our opportunity, let's sell out of this. So very interesting to me to see that they went with this direct listing approach and are trying to include a lockup period where the insiders can't sell as many shares or are restricted with how many they can sell. So again, another red flag. The next reason is they've been in business for 17 years now, and they are still not profitable. And with really only having two main products and then the third just being, how the software itself, that, again, is another red flag for me because what's taking so long to turn a profit? Now, maybe it's because they didn't want to use salespeople for the longest time. That's all I could really think of. Because if you want to put it in perspective, it took Amazon a little bit more than 14 years to turn a profit. So, yeah, that's only a 3-year difference. But during that time, Amazon created their website store. They were buying planes for their shipping. They were buying all these buildings for their cloud storage services. And they were really expanding their business in multiple ways. So it's a little bit better of a reason for it to take 14 plus years to turn a profit when you're truly just growing and growing your business and, maybe dipping your hands into too many different fields, but still you're doing it. And so obviously that's going to all cost money. But when your business is really just data analytics, which I'm aware is expensive for the infrastructure, but it takes 17 years to turn a profit, is just something I would have more questions on. And that leads us to the last thing is that, they are a new company. So we don't know that much about their financial history in the past. And I've said before, I like to see a few years of numbers, generally like 5 years of numbers, but I know it's not always possible, to really see how this company is going to perform in the future, or even at least 3 years of good, solid financial information would help me understand how this company is headed or the direction they want to go into. But we don't know that. And so for that reason, we don't know what's taking 17 years to turn a profit. Yeah, they're headed in the right direction, finally, as they're going public, but maybe they waited for this moment when revenue is growing and the losses were decreasing for them to actually start hitting the public markets. Also, again, for a company that has significant losses the way they do, I still just feel an IPO might have been a better approach because it would have allowed for them to receive more funding. That's my opinion. I'm not an investment banker. I'm just Matt. So take all of that with a grain of salt here. While I do think this company has potential, and data obviously is going to be a huge thing in the future, I'm still going to sit on the sidelines. I'm not counting it out, but since I don't invest in IPOs or direct listings, it's already something that I'm going to hold off on. And I just want to see where this company is going to be headed in. I can totally understand the optimism that they have, especially with the government making up about 52% of their revenue. The government's not going to go out of business anytime soon. So you could say that is a safe investment. But I just feel like there's a lot of questions that I have for this company with minimal answers to keep me away from purchasing this stock or adding it into my portfolio. Again, that being said, this company is in a very unique industry and data is a growing industry itself. So I understand if people are jumping into the stock. Me personally, I'm not going to. And also forget it. That's it. So yeah, that's my thoughts on Palantir. I'd love to hear your thoughts about this company, if it's one that you've considered or if you've already added it to your portfolio, or let me know if you have any kind of feedback for this, or maybe if there's any information about them I'm missing that could make this more attractive of an investment. With all that said though, we're going to wrap up here. So I hope you liked this video and I hope that it gave you some value out of it. If you haven't already, I hope that you consider subscribing to my channel. It's free and all you have to do is click the button. And while you're over in that region, just a few paces north is going to be the like button. So if you don't mind hitting that as well. I'm so bad at ending these videos. I was doing well, but I'm so bad at them still, so I'm going to stop myself here. Thank you so much for taking the time out of your day to watch this video. You could be anywhere in the world, and you're right here with me, and I really appreciate that. But I will let you go ahead, enjoy the rest of your day, and I will see you next time.